Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite, we have my partner in crime on Nasdaq's Markets Intelligence Desk, Chris Dearborn. We're going to have a preview in front of jobs data, review the FOMC, talk about everything else going on this week. And Chris, you guys on the mid have had quite a week, over 100 S&P companies reporting, and the big names too. FOMC yesterday, looking at jobs data tomorrow, a bunch of other economic data. It's been quite busy. Were you surprised with the FOMC reaction at all?
You know, it's a dovish note that the markets really needed to get this market continue to move. We're looking at one of the best Januaries in years, if not decades. And if this pulls through, like we expect it to here in the last hour of trading, it'll be one of the highest points of the market turnaround that we've seen since the Fed opened their mouths back in December and sent us spiraling down to those December 24th lows. And then since he's turned around that comment, Chairman Powell and the rest of the Fed speak has been very dovish in nature. They've proven that they are market dependent, not just data dependent, and that bodes well for investors in this environment.
Right, I would say that that is the key to the turnaround that we saw from Christmas Eve, like the worst Christmas Eve that we've had in trading, I think in history, for that matter. And regardless of what you're hearing, rhetoric on the geopolitical front, what's happening with earnings, it is the FOMC direction that is driving this market, whether it's to the up or downside. It is undebatable.
We don't need to fear them anymore.
Right.
In a trading environment, what Powell has done and what the market needed was a shot in the arm, and he gave it to that. If you look at the Fed fund future rate right now, it's less than 2% for a rate hike for the entire year of 2019. You got a 25-ish% chance of a cut. So what you're looking at there is really the expectations that it's status quo until the entire house gets put back into place. And what Powell's done here is he's put his building block into the corner foundation of the house and said, we're good here. We're going to follow what's moving on along the markets. Now all we need is to get the trade and tariff piece put back in. And then, unfortunately, depending on how you look at it, the two parties talking again to really get this market moving. You put all those pieces together, this market's going to take off.
Do you think it's a wise decision with the Fed to stop the balance sheet? That, you know, they were decreasing the balance sheet, they're going to stop doing that. It's quite clear that they're not going to do any more interest rate hikes. The economy is performing well.
Yes.
Rising interest rates in that kind of environment is not a bad thing. I wonder if it's the market psychology over the past 10 years. There's a generation of traders that have never traded a volatile market or a higher interest rate environment. Is it gaming it in a way, or, you know, structurally?
Right. That's an interesting question, and it poses a couple different theories. So one theory is that the economic data is so good that you should go back to a normalization, and that includes putting it on autopilot, which sent the markets down. That was the commentary. That was the press release. Remember, after every meeting now, he's going to have a press release with Q&A to qualify what he says or what the release says. And then the other part of it is that and the Fed in the past has never been market dependent. They're backward looking to forward thinking, as opposed to now looking to forward thinking, and now being market dependent, which is exactly what we've seen. They're proving that they're both. So it's the evolution of the Fed to what's moving the markets here. And what they're doing is that we're not going to turn a deaf ear. We're going to be listening to what's going on in the marketplace, good, bad, or indifferent.
Right.
That could come back to bite us too. So the flip side of that is, if you're too flexible as opposed to being constant, you're going to be throwing bad money after good. You're going to be chasing returns where you're going to have artificially inflated earnings. You're going to have an artificially inflated bottom and top line. And what that means is that you can't do a full fundamental valuation of the markets as a whole, not to mention individual stocks.
Right.
So with that, it's a double-edged sword. He's going to try to walk this tightrope. But right now, the foundation block is in, like I said before, that we are going to not have to worry about the Fed throwing water on this rally. And that's kind of where we are right now.
All right, let's talk about the good economy that we're in right now. Key jobs data report coming out tomorrow morning at 8:30 a.m.
Right.
What are your expectations into that? Because, you know, it's just this, it's so confusing. Sometimes bad news is good news and good news is bad news. But I think if it's telegraphed that the Fed is not going to react to these, to at least this data set tomorrow.
So the Fed is definitely bad news is good news for the markets.
Right.
Right. So non-farm payroll tomorrow, looking at 165,000. They had over 300,000 in December. You had a very high first time unemployment claims number this morning. It's the highest it's been since September 17, I think, at 250. That's not really a factor because people are like, oh, you got to worry about the government. You don't have to worry about the government being shut down because if you're a governmental employee, you're not claiming unemployment if you were furloughed. So that number doesn't really play into that as much. If the part-time workers, that's separate. But what you're looking at here is really where is the motivation going to come. We're not really so much concerned about the new jobs. What we're looking for is wage increase. That's the key. And then, those who have given up looking for jobs. That was a super low number last month. And the question is, will that continue? If you're looking at the job rate and people going back to work as a whole, it's not the skills, it's not the number of people that are working, it's the skill set that you need, and you need to pay for that skill set. So that's going to take time for education. It's going to take time to retrain people. If you're going to go out and get a manual job or work in retail over the Christmas break, you're going to start rolling off of that now.
Right.
So that's what we're looking for. Did people find meaningful jobs in the services and retail sector, or are they, and they're staying with those jobs, or are they moving up to more complicated technical and other items that need a little bit more training and skill work to move into those positions? And that's where we're going to be. If that works, that's a strong sentiment. That's another piece to the market, making this market move higher.
Right. Well, I mean, look, it's a buyer's market for employees right now. If you have the STEM skill set, you're in a really sweet spot right now.
But absolutely.
And all right, let's wrap this up and talk about earnings. A 2.2% beat rate, sales growth a little bit higher, earnings growth rate a little bit higher. Kind of a little bit of a mixed bag this week.
This is the heaviest week for the quarter of earnings. You've got big tech.
We have Amazon tonight. We had
Facebook
Apple
the other day. You've got Amazon, Microsoft last night. What you're looking at is just that, a mixed bag, but a strong bag. And you've got such low bar set on guidance that companies are really just kicking it out of the park. They're really doing well. And with that, you expect the guys who set a low bar, especially those who are heavily weighted in the indexes. If you look behind us, you have the S&P and the Nasdaq. The Dow Jones is another one on price point. Boeing was up significantly yesterday. They're leading the Dow down today. Even though the Dow's rallied up, they're the leading down stock in the Dow. What you're looking at there is the weighting of those large mega cap companies that took us higher to begin 2018. Remember, January for 2018 and early February was fantastic for the markets. And those are the stocks that led us through all 2017. They've set a low bar. If they move up above that bar and start to move higher, there's nothing really overhead to stop them from moving us higher. So if Amazon comes out strong, this market's up again tomorrow to start February. You had a strong, Facebook came out and Facebook got beat up significantly for over the last quarter, and they're starting out great. They're being rewarded for making money, and they still make a lot of money. And with that, you're going to get rewarded with shareholders buying the stock. And with your projection, if they have better guidance, those are going to be people who are going to be continuing to buy the stock, which is going to leave this market higher. Remember, it's all about the guidance that they give now, not so much about how you've done in the past quarter, and that's what's going to move this market forward. Strong guidance means a higher high for the market as a whole.
All right, Chris, thank you so much for that. We'll catch up tomorrow at 2 o'clock, as we always do on every Friday, to wrap up the week and look at the trading week ahead. Thank you for joining me, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.